everybody, and welcome to Mind Print Hash for week 31 of 2026. I'm your host, Cameron Otsuka, alongside Matt Dines. I'm going to get it right out the gates here. I am in a different location than normal, doing some traveling, so doing this from on the road. But Matt, as always, is back in Seattle for today's episode. But this week, we're going to go ahead and dive into the recent Fed rate decision. Matt has identified a few key points that might have gone under the radar across more of the mainstream kind of headlines and news sources that you might be familiar with. And additionally, we saw the first bonds issued by China linked to a new type of rate, which might mirror some things in history that we've seen with the U.S. dollar's monetary system. So really interesting stuff from Matt there. And then finally, I'll provide an update on the Hormuz situation generally, but really going to focus in on the missile headlines coming out of Lockheed Martin and the U.S., et cetera. But let's go ahead and get into it. Matt, like I mentioned in the intro here, you saw some things in this Fed rate decision. What kind of stuck out to you?
All right, so yesterday's FOMC decision came in at no change. So if you're following X or just the broader commentary today, it's either what you're going to hear is nothing ever happens, or what I'm saying mostly is, oh, Warsh is losing control. He's going to lose credibility. That type of framework. But yesterday's decision, like hold rates at 3.5 to 3.75%, basically everything stays steady as is, despite the underlying upward pressure that's hitting or that's wanting to drive money market rates higher. This was the most probable outcome going in. So this was favored 2-1, no change, versus the roughly third probability of a hike. Like we've talked about on prior episodes, that upward pressure continues to build. It just may take longer ultimately. Like we can delay that rise from happening for, I don't know, could be months, could be quarters. We'll just have to wait and see how things develop. So like I said, at face value, those two narratives tend to dominate. But I think what we're seeing in the response in the yield curve following that decision is actually your North Star guide to what's actually going on and dominating under the surface. So just to talk about this for a second, at the front end, when I talk about the front end, I mean money markets, 12 ranging from overnight rates to 1 year maturities for that defines, we call that the money market, as opposed to everything outside of that. You'd call it the bond market for lending, more broadly. But what we saw in response to front end yields after that decision not to hike was kind of the same thing, for all practical purposes, as like a mini version of a rate cut. It wasn't a rate cut, but as we said, that pressure had been building from, I guess we call it the hawkish side of money markets to increase rates. As we've seen, the European Central Bank has already had to give in to that pressure to hike rates as far back as June. The Fed is in a different situation. The U.S. economy is much stronger and has underlying growth to lend into under these prevailing dynamics that these other central bankers do not have within their economies, just to put it bluntly. So what we saw in the front end was as much as almost 10 basis points taken out of front end yields. If you look at the bottom chart in green, I've got the yields at the end of the day after yesterday's FOMC press conference announcing the policy decision, and then the yellow dotted line is the Treasury curve going in, or at the close of business on Tuesday. So what we saw is 10 basis points almost, probably came in about 9. For the spot on the yield curve, it's probably about 4 months from now. So if you pace the calendar 4 months, that's roughly November, election day. We'll talk about that in a second later. But 10 bips taken out of the front end, and then a little bit, but that effect kind of dissipates on the other kind of legs of the butterfly in money markets. So that's like I said, that's easing on the front end of money markets. It's almost the same thing as though the Fed had, or as a Chairman Warsh had gotten up and delivered a cut effectively. So what this no change in rates means, like in practical implementation, is that the FOMC will continue to buy Treasury bills. Remember, we talked about last December that transition to the RMP program, Reserve Management purchases, echoing the ample policy or ample reserves policy that the Fed continues to operate. Um, and what that means to hold rates in that corridor means the Fed or the FOMC is, or Federal Reserve Bank of New York at the implementation desk, is going to continue to buy Treasury bills. They're going to do that regardless, but they'll do it in a quantity that is greater that, like, had they otherwise allowed rates to increase. So if you think about
I
this,
see.
like the U.S. Treasury needs to raise a certain amount of money, every week to keep doing what it's doing, and one of those things it's doing is buying Patriot missiles from Lockheed Martin. We'll get into that at the end of our story. But what this policy actually amounts to keep rates lower, think of it as the mix. Fed is going to come in and support with a higher degree or quantity of bills purchases than it would have had it allowed that policy corridor to rise, which means the load of who's going to finance those the debt expansion that the Treasury needs to undertake to continue running its planned operations uh, for the next, at least going concern up until September, the next policy rate meeting. All of these are going to be live, but that the brunt of that mix, the Fed is saying we're going to keep you know, doing our existing lion's share of that private market. That's capacity. It doesn't have to come in. And what you're actually doing there is you're steepening the yield curve, in effect, holding short-term rates lower. The slope of the yield curve incentivizes credit creation within the U.S. economy. You can only keep doing this so long as there's demand from households and corporations to continue financing projects, or for
Right.
households, it could be consumption. But at the end of the day, it comes down to, is the real economy or the private sector of the U.S. economy, do they continue to have robust demand for money, which is by definition credit or incremental credit expansion? So long as you see the U.S. economy hold up, we can maintain this steeper yield curve. So U.S. economy still in growth mode. Once it flips, right? Once we have to start hiking, that's your sign that we need to, or the US dollar money markets need to raise rates to attract more savings, more kind of buffer into money markets. And what that means is that growth on that's showing up on the longer end of the treasury curve is petering out. All so far, U.S. economy continues to hold up, but this is where your economic data prints, your NFPs, your GDP numbers, all of that are going to become more and more important these next few months. All right, just a quick note about the vote. We got a 9-3 vote, with the dissenters coming entirely from the regional bank governors. So you had Minneapolis with Kashkari, Cleveland with Beth Hammock, and Dallas with Lori Logan dissenting. There could be some political nature to this, but if it was going to be like primarily political, and like I view Neil Kashkari as a political animal, some of these regional bank board of governors are more political, some of them are less. Um, that's kind of obvious. But where the politicization of these voters really shows up, in my opinion, is the FOMC slots. So the 7 on the board of governors. This is where like the Lisa Cook Supreme Court case comes in. All of that jockeying. There's been a lot of discussion about, hey, does Warsh actually have control over this board as the chairman? All of that. Could he get outright rebellion if he does X versus Y? With this meeting, you actually did see a 7-0 consensus from the 7 FOMC or Board of Governors members, which are appointed by the executive, approved by the Senate, all of that. So that's where you'd expect the real politicization kind of effect to show up if there was a lack of consensus within those seven. So for now, at least, this is meeting by meeting. That process of just let's call it polarization, the tug of war for control over the Fed as we're moving into an era of reform on what this institution means. That's still downplayed or on the back burner, which is a positive, and
Yep.
my framework or my opinion. So for now, I'd lean towards those three dissents since they're bank, regional, Fed. The more charitable or favorable and probable explanation behind those three dissents is could be that they're seeing the early signs that demand for borrowing is softening in their jurisdictions. So think about that: Minneapolis, Cleveland, Dallas. That's like your interior of the
Interior.
U.S. economy.
Yeah.
It's non-coastal. That's where a lot of the actual real growth is. You could also say it skews towards the South, but you could say Rust Belt revitalization, the reindustrialization of America, all of that process. A lot of data centers going up, all across the country. But all of these effects are spread. You see it on all regional Feds, but the fact that you're seeing it from these three, this will be a key thing to watch in the following months. Talked about the data prints, but like I said, we need that domestic U.S. economic growth to continue. And this could be an early warning sign that these regional bank presidents in the survey of their jurisdictions, their member banks are telling them things about what the lending market looks like in their specific neck of the woods. So this is a thing that we all should continue to watch. All right. So a quick look at how markets are pricing policy rate expectations going forward with their hedging activity. We now see a hike fully baked in by the December 9th meeting. So if you look at those numbers, we cross over from the October 28th meeting of plus 0.88 hikes. Then you get to the December 9th meeting of plus 1.278 hikes. A hike is 25 bips. You cross over to the hedging activity is saying like, yeah, that point where we go over, where we get over the hump and the Fed has to give in to this pressure to incentivize more savings and private capital into money markets. That crossover point is somewhere between like Halloween and mid-December, which, if you think about this in timelines, when is election day? First Tuesday in November. I don't know the exact number of the date, but very handily, we've seen this in the past, right? Where elections create these deadlines where maybe the direction of interest rates or Fed rates or Fed policy purposefully doesn't do anything in that window up into elections. Well, if you're looking for the most probable outcome here, if history is your guide, that decision to hike will be kicked down the road until we get past those key November elections. There's a lot riding on the results. Going forward, I don't think we need to go any deeper into that right here, but it should be obvious to everybody. So that would make sense if you're trying to weigh probabilities here. We've got two meetings. We got September, October, and then a third before the end of the year, December. My probabilistic, my base case would be two more of going no change if the broader economy, the data comes in, all of that market activity, allow two more of these meetings, like to just copy paste what we saw yesterday, and then by December, you would assume that hike, that direction of travel that the rest of the global capital markets are pointing towards, will be forced to materialize. All right. The last note: there was an Easter egg buried in the final question of the press conference that Chairman Warsh took, and there was quietly a bomb dropped that He is only committing to giving these FOMC press conferences through the end of the year. So
Right.
that means 3 more meetings of hand holding. Then we get the next big step, as you know, it's been clear in the first Warsh press conference in June, and then echoed yesterday. This era of forward guidance is coming to an end, as the revamp and transformation of the Fed as an institution takes place. This will be a long-term story, but that was quietly a band-aid being ripped off, that I haven't heard many people talking about yet, but
Agreed.
that's important in my book. So we've got big developments in store at the Fed. This was, if you just listen to what we talked about for the last 10 minutes, this was very clearly not a nothing ever happens meeting.
Right.
All right,
And let's stay
Cameron,
on
you
the
want to go
topic
into
of
DR rate?
rates.
Yep.
Yeah, I just kind of want to segue to you, frankly, because this is a situation where I was reading up on kind of what these are, all of that. I think obviously Matt has that capital markets experience; he could explain these in much more detail. But the headline came across that China, for the first time, Chinese banks have issued a DR-linked bond. So Matt, maybe for our audience here, can you explain exactly what a DR-linked bond is and why? I kind of hinted that this might be mimicking or kind of paralleling some things that we've seen historically within the U.S. monetary system. How does this relate to that?
So this is a story, um, new theater, same broader new chapter in the same broader kind of story going on, I'd say, in the transformation of interest rates post 2008 or post GFC. Just for context here, the big story, the biggest of big in this process has been, as we've talked about, the transition away from LIBOR and the offshore dollar standard towards the secured overnight financing rate, SOFR, and that center of gravity moving into the U.S. domestic financial system itself, and that's within the U.S. dollar kind of credit markets. So that's kind of the broader context we're seeing here as we talk about this China depository rate, or DR, that we're seeing spun up as another pilot project. So last Friday, we saw a headline that 3 Chinese banks had originated the first customer loans indexed to this depository rate, or DR. It's another short-term money market rate, like reference rate, like we talked about in the Fed policy, et cetera. I talked about money markets. This is the actual rate that's being spun up as a pilot project within the Chinese banking system. All right. So, like, talked about LIBOR in that transition from like an unsecured reference rate that was not based on any market activity. It was just 16 member banks, or associated votes, who at the end of
Yeah.
every trading day would come in and say they'd print a number that was supposed to represent what the interest rate would be on an unsecured loan that you would give your best, most creditworthy customers, right? Not a market price, so you can kind of you can make up whatever you want.
Yep.
SOFR is tied to market-based transactions between borrowers and lenders that are custodied at a third party, and there's actual skin in the game. You have to pledge real collateral, a treasury bill most commonly, to backstop your own short-term dollar financing. All right. So with that context, what this DR rate represents is a new interest rate that is it's now a secured reference benchmark um, that operates on short-term time horizon. So there's overnight, 7-day, and there's longer borrowing intervals, but they're all short-term. So it's focused on money market, and it's a collateralized loan between financial institutions. Now, what's being built on top of that is credit lending from these financial institutions to their commercial borrowers, right? And so that's what this step is with this headline of the first DR linked loans issued in Hainan. We'll get into Hainan. It's an island on the southern coast of China, very close to Vietnam, all of the, the Southeast Asian economies, or smaller countries around the South China Sea. All right. So the banks involved on this are Industrial and Commercial Bank of China, China Merchants Bank, and Shanghai Pudong Development Bank. So for most people in the audience, these are not household names. We'll get into that in a second, but they're actual hitters. There's real weight behind this within the Chinese banking and financial system. All right. So how does the DR work? Like I said, it's a secured short-term lending rate, like specifically for the domestic Chinese financial system. The IOUs are backed by a borrower's high quality collateral, which is primarily going to be government and policy bank bonds. It can also include People's Bank of China bills and other state aligned bonds in the collateral pool, but those will make up a much smaller expected share of the pie. It's mainly going to be central government bonds and then their associated policy banks. What do we mean by a policy bank? They're state-owned banks that exist to carry out the government's policy goals. So it's like China. It's going to be banks like the China Development Bank, the China Exim Bank, and the Agricultural Bank of China. So it's actually happening here as you're thinking about this. You're connecting all of the Chinese yuan denominated lending ultimately down to financing the existing government, right? So to access more, to demand for money is essentially what it's doing is propping up the existing government, similar to the way that demand for dollar funding now, you have to prop up or fund at the end of the day the U.S. Treasury because the collateral in the SOFR market is primarily going to come from U.S. Treasuries. All right. Yeah. So at the base layer, what this is doing is connecting lending in the private sector of the Chinese economy to the IOUs that are directly funding and financing the state and its objectives. All right. So I want to go into the three banks here because it might not be apparent like that this is actual like real capacity. So the two behemoths, ICBC and CM Bank, they're number 3 and number 5 in terms of equity market cap in the Chinese economy for financial institutions. This is according to just a website like commercial or market cap, something. I'll find the reference if we need it. It's easy to Google. And then number 12 is the Shanghai Pudong Development Bank. So you've never heard of these, but they're actually, or most of the audience will have never heard of these unless you're coming from either some interactions with the Asian economies as like an importer, if you're in the United States, or if you've got some other experience in China. But I'd assume most of the audience is unfamiliar with these names. But ICBC is the behemoth. If you look at this is just some comparisons here for who this should foot to in your mind. So they're on scale with a Morgan Stanley or a Goldman Sachs. They're like, in terms of largest in the world, they're, right now mark to market number 7, sandwiched in between those two. They're bigger by a significant degree than household names like Royal Bank of Canada, Wells Fargo, Citigroup. So that just puts that one into context. And then CM Bank is actually bigger than in mark-to-market terms than institutions we've talked about on this show before, like BBVA. We talked about them. Their largest share of the Mexican commercial banking franchise. Unicredit, the largest Italian bank, BNP Paribas, France's major, Capital One in the U.S., or BMO in Canada. So just between those two, you've got real financial heft behind this pilot project, and then Shanghai Pudong, much smaller, but they're still top 100 globally. So you got some real partnership. Now, if you go into Hainan, why was this chosen? I've got the map up. It's an island off the coast of China, and kind of traditionally, if we try to frame this monetary story and what we're living through now in the context of like 400 or 500 years, and the expansion. Like our story kind of picks up where the Silk Road is in decline and the maritime trade routes begin to flourish with Christopher Columbus, right? So we're talking 500, 600 years here. Um, if you think about Hainan within the Chinese domestic economy, and then its interaction with the rest of the world. Um, Hainan has been much more defensible for the ruling government, which tends to sit in Beijing across the dynasties in history, going back thousands of years. Hainan, I don't know if it's just because of the larger footprint or the easier land bridge connection via the kind of the peninsula jutting out, whatever. Um, it's been historically much like that domestic, central government that sits in Beijing. It's been much more successful at maintaining its sovereignty over Hainan than other kind of competing uh, locales that interact with the rest of the world, like Hong Kong, Taiwan, etc. Um, so Hainan, like, why would you pick this as a pilot project? It's a good kind of sandbox as it's a free trade zone, if you will. It's interacting with the rest of the world, not just in trade, but also cross border finance and capital markets, and it's defensible. It's smaller, much smaller than those other two economies, like Hong Kong, Taiwan, but it's a good sandbox for um, the mainland Chinese government to pilot a new program to see if really what's going on here is an effort to integrate its own domestic financial system, which is much younger than even like an upstart like the United States, which is much younger than an upstart like the European or London-based financial system. Um, it's a good pilot ground for the mainland Chinese economy and its financial system and its central government to um, bridge to this broader trend that we're seeing play out in real time. It's been underway since you could say 2008, but starting with the SOFR launch in I want to say 2017, 2018, and everything we followed or seen, follow over the last 8 or 9 years. What this actually represents as a pilot project is an integration with that broader trend of that offshore dollar centered in London that's moving towards the onshore dollar and then the stablecoin dollar, as um,
The new edition.
the follow on or the internationalization of that process. But this, if you think about it, where if you want to read the tea leaves or where they're going, this DR rate, what they're trying to do is find a way to bridge into that existing thing while still maintaining their sovereignty. When I say they here, I mean it's Xi Jinping's government or the sovereigntists within mainland China themselves. So yeah, this reflects the tip of the spear, but like this represents a path where China's benchmark rate for lending within its own banking system and domestic economy is being configured, and future credit expansion is being configured to plug and play with the rest of the world, which is on that SOFR standard. Um, so if you map out that trajectory, that's and forward looking, it's just drawn in pencil, not pen, right? Let alone written in stone. But this is a positive story in my framing for veering off the path that would like the Thucydides trap kind of framing where some parties want to take it, some financial players want to take it, which would put the U.S. and its allies on a collision course for kinetic conflict between the U.S. and China. Um, this is an effort so if to steer it's a fork in the road that's away from the broader, I don't know, call it World War III, call it whatever you want, because what happens here if these Chinese banks like ICBC, CM, etc., are successful at getting adoption from not just domestic or borrowers for production to finance exports to the rest of the world, but also get like foreign state-owned enterprises or foreign financial institutions to borrow at this DR rate. You can plug and play these the Chinese financial system with the direction that the American sovereigntists, as we call them, um, want to take the dollar system. So complicated development, but um, big picture, like this is like the early seeds in that process, the success of this DR rate pilot.
Right. Yeah. And let's take it then from there. You did mention the kinetic. Hopefully, we do not go there. Just to be clear again for everybody, but we do see some kinetic operations going on in Iran, and this directly ties into what are we funding, right, with these treasury bills, things like that. So the first headline here is Lockheed Martin getting awarded a $58.6 billion contract by the U.S. government, specifically to produce the Patriot missile system. It's their PAC-3 MSE interceptors. And I'm saying that it is important. There are a variety of other interceptors and missiles and things that we do need to produce. But you're probably hearing a lot in the news today about America's missile stockpile. I believe Pete Hegseth, Department of War, mentioned this as well in testimony that we were already low in missiles ahead of the Iran war. Obviously, coming through that, we've been using a lot of those, and both offensively and defensively. I'm going to come back to this slide because there's some key points on I want to get back to, but I think the context here is really important. So this is a table put together by the Center for Strategic and International Studies. So I cannot claim any ownership over this, but what they've done is they've estimated the pre-war versus mid-war inventory of each of these different types of munitions, missiles. So down the left-hand side here, the SM-3, SM-6, THAAD, Patriot, and that's specifically the one that we're talking about right now, in this red box, are used generally defensively. And so the reason why I'm calling this out is that it's usually used to protect ships. So if we're trying to put personnel and ships in range to go and attack a specific target, you hopefully have some type of defensive munition to be able to stop any incoming threats. And so you see here, pre-war inventory, we're already we're in the thousands, right? So just imagine the entire United States having just 1,000 of these SM-6s as an example. Patriot missiles, we had 2,300 just about. And then as of this table, we're estimated to be close to that, just over 1,000 missiles remaining. So if we think about the tactics of this, again, like I mentioned, generally defensive. The Patriot missiles can be ship-based, can be land-based on some type of a truck or something like that. But again, you're usually putting these in position to try to let your forces go in and ideally take out whatever might actually kill U.S. soldiers, right? So when we're talking about things like the Iran war, we're supplying these missiles to our allies who are helping, move forward American objectives. But likewise, the American government, you need these for, let's say, a broader war or other flashpoints that might happen over time if those were so to happen. The other thing I want to call out here is this delivery timeline. So on the right-hand side, this is in months. And what they've done here is they've included the entire pre-manufacturing lead time as well. So the contracting time, all of that, gathering the materials and resources, and then the actual assembly time into this final delivery time of 42 months. So, we're talking right now about the U.S., with this headline with Lockheed Martin, that we're going to start contracts to produce these Patriot missiles, given no changes to the current contracting system, their output, things like that. That's 4 years away. So just something to keep in mind there. And then the final thing I really wanted to point out here is that the 2032 date that they've set on this contract. We've talked in the previous episode about all these different deals that we've been working on with countries like Iraq to try to route around some of the Hormuz choke points for oil and other resources. We've got deals in place, working towards deals with other countries on things like PAC Silica, trying to gather these critical resources that we need to go develop these things. But I think there's a little bit of a hint that maybe we might be expecting to continue to see some flashpoints, some kinetic confrontations over the next couple of years, and it's not going to be something that's solved in the next year or two. like we might all be hoping. So
Mm.
all to say, I do think there's some good in this. Obviously, if you I'm not a fan of the military industrial complex, but I think if you're looking at this from the type of missile they're trying to produce and the type of stockpile they're trying to resupply, rather than go out and say we're going to go build a brand new set of offensive capabilities, this is definitely a step to try to replenish that and protect American soldiers.
Yeah, so something we didn't touch on, the key thing here, this almost $59 billion contract. I think, if you all right, there's different types of procurement deals versus country to country sales. Um, this is one of the bigger ones, I think, in history in terms of production capacity
It is. Yep.
expansion. So this would take the annual production capacity of the Patriot, the PAC-3 MSEs. I'm not going to pretend. I'm not a missile expert. I'm not even going to pretend to stay at the Holiday Inn last night. My point here, the key thing, because I want to translate this in capital markets expectations. Um, Production capacity is being ramped up here with this deal from 650 roughly annual production to 2,000 is the target. So we're going to expand capacity, and this process is, it's a multi-year contract that, Cameron, as you mentioned, 2032. That's 6 years away. So if you think this, what we're seeing in Iran is going to be wrapped up quickly, maybe it is, maybe it's not, and there's being progress made every day, or it's a tug of war. Some days, 2 steps forward, 1 steps back, whatever. Um, and then the broader, the arena here is global, right? But this is in my read. This is telling me, oh, we opened up Pandora's box. You could say it was definitely clear with February 2022. Probably predates earlier than that. We've been working up to this, but if you think we're going back to the capital markets you saw from 1980 to 2020, like it's not going to happen. And this is your signal of where the defense contractors are being asked, or what they're being asked to procure for the U.S. government. Um, we talk about this from week to week or Fed meeting to Fed meeting, but like the broader backdrop, this is going to be a multi-year environment, and so the underlying kind of plate tectonics you've seen, the shift underway the last few years, this isn't going to be finalized, wrapped up, tomorrow. Is my point there. This is a much longer trend, unfortunately, but it also tells you, if you're of the opinion that the U.S. is, not going to be able to finance this, or not going to find a way to fund it, or um, preserve its existing control over the global trade and monetary franchise. There's 2,000 patriots per year to tell you otherwise.
That's right. Great.
All
Well, I
right.
think that's our episode for the week. Thank you all for listening in. As always, please like, subscribe, tell your friends. We're at MyPrintHash on X, YouTube, Substack. Matt is at LeveredUSTs on X. I'm at Cameron Otsuka. And see you all next week.